Depreciation. Over time, the value of large items gradually decrease. A car bought this year will not be worth the same amount of money in a few years' time. Obviously, it's brand new, it's been used, so there's wear and tear. It's not going to be worth what it was when you first bought it. And a new television for $2,000 bought today is unlikely to be worth anywhere near this amount in 5 years' time. Large equipment, machinery, and other assets used in a business also lose value or depreciate over time. So the depreciating value of equipment is often taken into account when calculating the actual costs of business operations. So it is very important for businesses to be able to estimate the likely value of an asset after a certain amount of time. And that is something that is called the future value of the asset. So after a certain amount of time, or when the value of an item is depreciated to a certain amount, it is called its scrap value, where the item will either be sold straight away or disposed of, thrown out. At this point, the item has reached its end of its useful life and will be written off. This means the item is no longer an asset for the business. So very important to understand what they mean. So individuals often use the depreciation in value of equipment to calculate tax refunds. So in Australian taxation law, when individuals buy equipment such as computers or other items necessary for their work, they can claim that as a tax refund based on the depreciating value of the assets. So there are a number of techniques for estimating the future value of an asset. There's two ways that we can do it at the moment. So the first one is called flat rate depreciation, and the second one is called unit cost depreciation. And we'll have a look at how both of these work.